Welcome, everybody. My name is Johanna Richter. I'm your host of this webinar. I am the Managing Director of Nihilo, and I'm very proud to have such great speakers this webinar. Hans van der Hurk is an international tax advisor with extensive experience in international tax strategy and controversies. He has run several cases before Dutch courts and in European Court of Justice. He is also a professor in international tax strategy at the Maastricht University. He frequently speaks and publishes on international tax issues around the globe. Some of his contributions have been translated into Spanish, Italian, Chinese, and Japanese. But this webinar will be in English. Besides this, he is a member of the Dutch Organization for Tax Advisors, Dutch Foundation of Tax Science, and International Fiscal Association. The other speaker is Robert de Vries, also Managing Director at Nihilo. He started his career at the international audit firm and has been working for and advising multinational enterprises and has gained extensive knowledge and experience about value and supply chains analysis. He worked for quite some time in the US and Germany. He is our transfer pricing specialist and can you tell you about everything about tax compliance tool later on in this webinar. This webinar is the first of a series. Every 6 to 8 weeks, we provide a webinar about tax insights. And we are very happy with all the registrations we have received for this webinar. We are also a little bit overwhelmed with the large number of registrations. And that's why we choose for a live event. The background of the participants is broad. We try to compensate this, but we also realizing that this can be difficult. In the following webinars, we will therefore indicate for whom the webinar is most suitable and make a distinction between the C-suite and tax suite. Follow us on LinkedIn for more updates. There's also a possibility to propose topics yourselves for the upcoming webinars. Just send us a message via LinkedIn or email. So as you can see, we have 300 registrations from 52 countries. So I would like to welcome everybody. I put in some names that came by the registrations. And the top 3 female names were Maria, Simone, and Tanya. And the top 3 male names were David, George, and Jeroen. But also a big welcome to everybody else that I not can pronounce correctly. Sorry for that, but a big welcome and hopefully you have an interesting webinar. A short introduction from our side. Our goal is to advise our clients to be compliant and minimize risk in the field of transfer pricing. Our knowledge of supply chain and value chain helps us to understand processes in detail, enabling us to accurately describe the actual situation as required by the OECD and tax authorities. Litigation is something that you want to prevent, and that's why we prepare our transfer pricing documentation from a risk of perspective and not only from a compliant one. We therefore work closely with Hans van der Hurk to realize this. Oh, sorry, it was a little bit too fast. We are preparing, like I said, transfer pricing documentation. We prepare the master files, the local files, country by country reporting. And for the preparation of transfer pricing documentation, we use our software for preparing the documentation so that we provide an efficient and consistent process. It's also possible for companies to use the same software so that managing the documentation and intercompany transactions will be easy. We prepare benchmark studies and we use for the preparing of these benchmark studies the Orbis database. This database is accepted and also used by tax authorities. We also develop in-house tax compliance tools. Robert will later on explain more about this, but also in the upcoming webinars, we will discuss the insights and possibilities of tax compliance tools in more detail. The agenda for this webinar is as follows. Hans will start about the future perspective of international taxation, with some interesting topics as you can read in the slide. Abuse in the modern tax arena, Pillar 1, the toolkits, with a nice casus India versus Vodafone, and Chapter 10. If there is some time left, Robert will tell you something about tax compliance tools. But before we can start, I have some practical notes. If the connection drops, then please try to log in via the link again. If we lose the connection from our side, then we have to start again, unfortunately. If that's the case, hopefully it will not be. Then we make sure that we publish the link directly on our LinkedIn page. For questions and answers, you can select the option Select Q&A in the right side of your screen. Type in your question in the compose box and select Send. We group the questions as much as possible and will include them in your presentation, in our presentations. But yeah, we are also aware that we are with a large number of people, so not always everybody can ask their questions and we cannot always answer them. But make sure that if you have a question, you always can contact us via LinkedIn or email, and we can look into the possibilities to answer your question. And final remark about permanent education. We keep a log of those that are attending at this webinar. And by fully following this webinar, it's possible to get a proof of attendance for permanent education. I have already received some questions about this. If you send me an email, then I will make sure that you get a proof of attending this webinar. So now I will give the presentation to Hans van Hurk. Thank you.
Joke, thank you very much. And for the people within Nihilo for making this all possible. It's a pleasure to be here today with such a huge number of people. And it is very much a pleasure still. It is also a very challenging pleasure in order to discuss a future perspective of international taxation for a diverse group of people consisting of tax advisors, tax directors of the highest level, but also people from a totally different category of background. So I'm going to do my best to make it a suitable presentation of all these developments. And as Joke already mentioned, we will try to, in the future, to have a regular topic being covered in, let us say, less than an hour, in order to bring, and let us just call it, the financial people up to speed, and otherwise the people from the tax arena. I will need approximately 50 minutes. I try to keep it on 15 minutes because on every topic I could probably speak 1.5 hours. I'm not going to do that, don't worry. We'll start with 5 subjects, as Joke already mentioned, and the first one is abuse in the modern tax arena. I will also clarify why I chose the topics. Well, abuse has been chosen specifically because we have seen the last couple of years so many changes in the tax world, with back to the MLI, with a new tax treaty backgrounds, a new tax treaty philosophy, actually, that many new approaches of abuse have been seen, developed in the post-BEPS arena. You read it in the papers. For years we saw many publication in the papers. And we see it now back. We see it now in the OECD and United Nations Model Tax Convention, which is the basis for tax treaties, more or less. We see it in the MLI. We see it in the transfer pricing guidelines. So more or less, modern international tax law is based on these new principles. The problem, however, is that these new principles are being perceived by governments as interpretation of existing principles, which means that the criteria for the future are more or less used in situations in the past. And that means that controversy numbers are high. And in this part of my presentation, I just walk with you through a few of the examples of new provisions, what they mean and how they could affect your business. And later on we will probably see, we'll see a slide from which I can give you a few examples on what can happen, at least what I experience in practice what will happen. So yeah, the first new article is Article 4, where a company is a resident was in the past always being determined on facts and circumstances. Mind and management of a corporation. The point is namely, in many court cases in the past, and there will be the number of court cases will increase, a situation where you have a company, a corporation, which runs a company, just an ordinary company, where the managing people have, for example, a global role and are CFO, CEO in also other companies. And then the question arises what it means. Are they enough in the specific country where the corporation is a resident, or could you say that they actually run the company from their location, CFO, CX, CEO location, which has as a consequence that perhaps that country can tax the profit while only a permanent establishment remains. In the new Article 4, the situation is becoming a little bit more difficult because the treaty will describe a situation which says that in a situation where two states will claim residency of a corporation, a mutual agreement procedure is necessary to find out which state is allowed to tax. As a consequence, if the mutual agreement procedure fails, doesn't bring the result we want, and the result we want is only one-time taxation, then both corporations, both countries can tax that corporation. Australia, for example, which is one of the very aggressive tax administrations of this world, already announced that they will, in a situation where there is not a solution, that they will just tax that corporation. The principal purpose test is a new test which actually tests whether there are what the principal purpose is for creating a structure, and that test is so unbelievably unclear that I can illustrate it with a principle. Suppose a US multinational wants to coordinate its European corporations, all kinds of corporations in any state of the European Union, and comes to the conclusion that there needs to be an intermediary headquarter in the Netherlands or Luxembourg or wherever. And then the commentary on the principal purpose test, so the principal purpose test has its commentary. The commentary says something like, well, there are a lot of criteria you can test whether the choice for a specific location is based on business reasons or not. And then they name them, like the people speak English, there's a good infrastructure, education is fine, political stable infrastructure, etc., etc., etc. They are all arguments, OECD says in its commentary, which justify the seat for an intermediary holding company, for example, in the Netherlands or Luxembourg. And then the last sentence of the specific part of the commentary says, but if tax plays a role, as if tax is something which has nothing to do with business. Tax always plays a role, because whatever decision you take, you always look at the tax angle of the situation. So that's one of the reasons why the principal purpose test is already used in many situations, for many tax administrations, even in situations where it was not really in existence. Anti-abuse provision, the general anti-abuse provision, is less specific and gives much more possibilities for states to just say, well, the treaty wasn't intended to cover the specific situation you're actually applying here, and therefore we reject the application of the treaty. Then you can go to the court and see whether you can win that case. And the fourth one is a transfer pricing specific issue, intellectual property. OECD developed a specific 5 specific criteria which are being used to see what part of your profit can be allocated to that IP or that corporation which has that, owns that IP. Development, enhancement, maintenance, protection, and exploitation. The Chinese put also promotion, so they have the DEM-PEP criteria. And they intend to prevent the situation that you have a profit, for example, in a group of states, and that profit from that group of states, that the profit actually is allocable to a specific headquarter unit, could be the Netherlands, for example, and then the Netherlands pays a huge royalty to a Caribbean IP corporation, whereby nothing really remains to be taxed in the Netherlands and everything is taxable at 0%. In those situations, the new rules will say, what can you actually allocate to the Caribbean IP company? And in practice, it's known that many of these old-fashioned companies have hardly any substance, so therefore the allocation will be limited, and then the residual has to be allocated over all the corporations in the group which contribute to the value of that IP, more or less. Existing provisions, beneficial owner is here already many years, has been improved as a rule in the Model Tax Conventions 2012, 2014, is getting much more important, also due to some European Union case law. I'm not going to discuss a lot about European Union case law since all our participants come from all over the world. So I have one slide with a few specifics later on. And limitation on benefits in the multilateral instrument, which is that instrument which was in the papers, which actually tries to harmonize all these new rules in tax treaties without having to modify all these tax treaties. There is this primary position, more or less, which says that any state should have, for example, as one of the most important ones, either a principal purpose test or a limitation on benefits provision or a combination of it. So limitation on benefits, the tax people know that from, for example, the Dutch United States Model Tax Convention actually, is quite complicated, and therefore OECD developed a simplified limitation of benefits test. So some states, I believe 2 European Union countries, actually implemented both. So as well the principal purpose test, as well the limitation of benefits. Difficult criteria, and of course there are more. Well, as said, many states take the position that even the new rules are actually just an explanation of the existing rules, and therefore they use the momentum to test situations from the past on criteria which are actually only applicable since 2017 on, depending on the treaty, etc., 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 etc. So in one of my court cases, actually in a Dutch court case, the tax inspector, it was a 20 2011 situation, and the tax inspector was there using the damping functions which are in the transfer pricing guidelines since 2017. And I know if you would look at the transfer pricing guidelines, you will find some criteria which look like the damping functions. However, the damping functions as such, as well as the consequences, are much more elaborate since 2017. So these kind of discussions you could probably get. Yeah, and as I said, the general anti-abuse rule is that vague that a state can just say, hey, the treaty was never intended to be applicable in these kind of situations, and therefore we don't apply it. And then, of course, if a problem arises, you can go in a mutual agreement procedure, which is in a way, a cheap way to solve a controversy, though the main issue is that you give your facts and circumstances to the tax administration of your country, and it will step into a procedure with the other state, but you're not a party in that whole procedure. So you never know what goes well. And one of the well-known facts about MAP negotiations is that if the Dutch Ministry of Finance goes to, for example, Germany, they have 15 Dutch cases and 18 German cases, and then it's a matter of, okay, what shall we do? You pick that one, you pick that one. And for an individual company, that cannot be the best solution, and that's the disadvantage of the MAP. The second disadvantage of the MAP is that MAPs not always come to a decisive solution. So sometimes the states just do not find each other, and therefore the MAP procedure will just hold without any solution, and then you have a bigger problem. And that could be the situation more and more in this world, since after the BEPS plans came, there was a discussion on Action 14. Action 14 is the mandatory dispute resolution, where many states have publicly stated that it's now payback time and that they didn't want to accept that mandatory dispute resolution simply because they want the money back. So what can you experience from this? First of all, a lot of subsidiaries in a situation with the US, for example, in top, will challenge the Dutch intermediary holding. They will say it's not a beneficial owner. They will say it doesn't have enough substance. They will say it's not intended to be covered by the treaty in such situation for a general anti-abuse rule kind of thing. They will say the Netherlands was inserted just for tax reasons, treaty shopping. There are all kinds of arguments being used to challenge that position. One of the worst situations I have seen, was it not on the slide, was from a Dutch multinational, not listed on a stock exchange, family owned, all the family members live in the Netherlands, where at the moment from a dividend distribution to the Netherlands, the German tax inspector said, prove us that you're not an intermediary company and you're actually just a US multinational. Well, then you can, of course, you can send all kinds of annual accounts, you can whatever, publicly stated information about the shareholders, privately information. A lot of things have to be sent to the German tax administration, officially translated, by the way, this situation by a translator who was registered, very costful. And in the end, of course, it wasn't a problem, but it's the way some tax administration look at these situations. And keep in mind, in Germany, you normally have to inform the inspector of the tax administration from a dividend distribution. So in this specific situation, the Dutch headquarters said to the director in Germany, just distribute the dividends. We will just go to the court because this is clearly nonsense. So he had to report to the tax administration. The tax inspector said, if you do that, then I will sue you personally. So the dividend distribution became more and more criminalized, and that's the reason why they chose the option for just going to the translation, etc., etc. So withholding taxes are quite clearly an issue, more and more, I would say, and they use all kinds of issues, all kinds of arguments, and in a few recent court cases from 2019 from the European Court of Justice, the well-known Danish cases are being used because in those cases there was clearly a matter of wholly artificiality, and there the ECJ therefore rejected the claim of the company. And therefore now tax administrations just suggest that all situations as we see them in practice are wholly artificial, because that's the entry to the possibility of rejecting a tax treaty, withholding tax rate, or a parent subsidiary directive withholding tax rate. So withholding taxes and abuse are combined. Transfer pricing is a huge issue. Whether it's Italy, Germany, and many other states, they ask again and again and again for information. Many traditional transfer pricing specialists tend to advise their clients into an advanced pricing agreement or a bilateral advanced pricing agreement. Keep in mind that these are rulings. I'll give you one example. I was asked to support in a situation where there was an advanced pricing agreement between the Netherlands and Italy, a bilateral APA, and you know the Italians are always quite strict, so they make sure that they get their piece of the cake and more than that. So therefore the part of the profit, just to make the very simple case, the part of the profit taxable in Italy was perhaps a little bit higher than you might have expected. And Germans, there was a comparable situation, and the German tax inspector just asked the company, let me see what you actually allocate to the Italian subsidiary in order to compare whether I get enough. And then you see that one bilateral APA actually has effects to a lot of other situations. So therefore, it gives, in a way, some security, but probably also a downside which you might not always see. Permanent establishments is also a hot issue. Many companies have activities in another state, and even if they have hardly anything in a certain state, if some states, Denmark is famous for it, they actually changed last week the transfer pricing and permanent establishment rules, but not in the better, I think. Denmark and permanent establishment is always a discussion on from a little bit of activity on which is not a fixed place under the Model Tax Convention, etc., would lead no fixed place, no dependent agent, no independent agent, no 5-4 specific auxiliary or preparatory activities, no taxable event in that country. Still, more and more states believe that there are taxable events in that company. Yeah, additional EU perspective, many cases of beneficial owner, on abuse, already discussed the Danish cases. And further on, we have seen the last couple of years a few other directives. The parent subsidy directive has been updated in 2016 and is the first ever directive which obliges the states to limit the rights of the companies under the directive. In the past, it was always so that the states were obliged to guarantee maximum rights to the company. So it was a change in attitude of the European Union with the combined states against the companies. And that Tax Avoidance Directive 1 and 2, of course, also, which should be mentioned. The Arbitration Convention is still a possibility to help in situations where transfer pricing leads to a problem within the European Union. However, we now also have an arbitration directive, which is implemented in the laws of all the EU member states. And keep in mind that the directive is only applicable on flows between the states, and it's not about how you categorize specific situations. So the question whether something is a permanent establishment or not is in principle not covered by the directive. Some states, like the Netherlands, did include it in their implementation legislation. And DAC 6, that's the mandatory disclosure rules, is of course also quite important. Everybody is aware, I assume, that any situation which ticks a box of the mandatory disclosure rule directive hallmarks should be sent to the tax administration. Well, probably adds to a big bag of information which is going to be shared in the international the CCN network of the European Union. Okay, Pillar 1. The status of Pillar 1. You know that the digital economy Action 1 of the BEPS plans just was a failure, and therefore the world wants to go to a new system where digital companies will pay taxes in the states where they earn money. Many states go on their own, equalization levy states like India, like France, like United Kingdom, like Italy. But the world is still discussing by the inclusive framework the possibilities to come to a global solution. And actually they don't succeed. Why not? Well, states like the US are going to lose a lot of taxing rights simply because that cake has going to be redivided, where a bigger part of the cake goes to the source states and less of the cake remains with the resident state. That hurts, and therefore they have said we are willing to work with you on a solution. It depends on which solution is going to be chosen. But one of the main issues for example, the US and many other states happily is that they want mandatory arbitration. And in the meanwhile, India already said we step out, because in our Indian equalization levy system, we levy 7% tax rate, which is much more beneficial for us than that whole OECD kind of an alternative. And other states, like many African states, have said, we don't trust arbitration. We believe it's an infringement on our sovereignty. So we will not work with arbitration. And so whenever you create a new system globally, you need to make sure that companies are not paying the price by paying taxes on the same profit in many, or at least in more than one state. Therefore, mandatory arbitration is essential. And the issues, one of the main issues for the US, for example, is how can you determine amount A, B, and C? Very complicated, and make sure that that goes well. For those of you who like to read more about it, I wrote quite an extensive article on the development of Pillar 1, the issues of Pillar 1, some suggestions to probably improve it in the EC Tax Journal. Whenever you send me an email, I will send you a copy of it. So many states saw this development from OECD go in the wrong direction, and therefore, as a light flash at a dark heaven, one way Article 12b of the United Nations Model Tax Convention appeared. The United Nations developed an alternative for Pillar 1. And in a way, it's not that strange, because the United Nations Model Tax Convention, which is a different thing than the OECD Model Tax Convention, is a convention which deviates from the OECD Model Tax Convention, and 5.6 of the UN Model Tax Convention is an example. In 5.6 you can read that a insurance company is specifically focusing on insurance companies, an insurance company selling insuring policies in another state without having there a subsidiary or a fixed place will always be taxable on the margin made on those insurance premiums in that other state. So it already is an example on how you could go in a way of taxing the digital economy, because it's comparable. You sell something in another state without having a fixed place, no permanent establishment, no dependent agent, no subsidiary, and therefore it gets close. And the UN seems to be following that path in a way which they call income from automated digital services. But first, some philosophy. I like this quote very much. When NASA first started sending up astronauts, they quickly discovered that ballpoint pens would not work in zero gravity. To combine this problem, NASA scientists spent a decade and $12 billion developing a pen that writes in zero gravity, upside down on almost any surface, including glass, and at temperatures ranging from below freezing to over 300 centigrade. The Russian just used a pencil and it worked. And in a way, this is what's happening here. The OECD alternative is so very much complicated that the UN alternative seems to be the best way forward to solve that whole issue. And I'm not going to discuss the whole Article 12b, just a few things. So you see income from automated digital services arising in the contracting state and paid to the resident of the other contracting state may be taxed in that other state. However, at the source state level, the contracting state may also, the state where it arises is also allowed to tax it. But, read well, but if the beneficial owner of the income is a resident of the other contracting state, the tax surcharge shall not exceed a certain percentage. So it actually says if there is no tax treaty, for example, then a country like India can actually tax any percentage because you're more or less free to do so. If the beneficial owner of the income is a resident of the other contracting state, then the negotiations will actually determine which percentage is going to be applied. So this is a difficult one in tax treaty negotiations, but at least it's a simple solution for solving, at least a more simple solution for solving the issue of the digital economy. And these are all details like how you determine the profitability of the activity in a certain country, and so on and so on. You all will receive the slides later on, and therefore I'm not going to discuss these details all. These are the exceptions on 12b and a sort of the last specific provisions. So what you see, that the text of 12b is very precise. Without good treaty negotiations, companies have a problem. So, and that's the strange thing of all these BEPS developments. They're actually all being intended to make sure that treaty shopping is less important and that companies choose for locations just for business reasons. But with all these new laws like 12b UN, you have to make sure that your beneficial owner is in the country which has the good or the better treaties with the source states in order to prevent that you will be taxed at a higher percentage, because the resident state is not always willing to give the full credit because they also have their criteria how to determine what should be allocated to that subsidiary. So there are some issues here to be taken care of. I leave this with these details. I think some last remarks. 12b was developed in less than 1 month. So at a certain stage, after the discussions, the endless discussions with the inclusive framework on arbitration, on amount A, B, and C, which take already place, I think, for 2.5 years, UN countries were fed up and said this is not going to work. And therefore, in good British or Dutch or French, it became an align gang. They just went for their own strategy and came up in 1 month's time with this alternative. And I expect this alternative to becoming very much more important. That brings me to indirect transfers, which is also a topic which is getting much more attention. And we will start, of course, with the Vodafone case. Vodafone was in a few disputes with the Indian tax authorities, not the most easy tax authorities, I can tell you. And the Indian tax authorities, they noticed at a certain stage the following situation. Hutchinson's in India, the subsidiary was held by, amongst others, a Cayman Island entity, and above was Hutchinson Telecom International Holding. And the Hutchinson International Limited sold a stake in the Cayman subsidiary right away to the Vodafone International Holdings BV in the Netherlands. So the subsidiary in India wasn't sold. No, the parent corporation of the Indian subsidiary was being sold to another company. In principle, therefore, under the tax treaty, India, I suppose there is a tax treaty between the Netherlands or between India and the Cayman. You can have a discussion whether, based on that treaty, India is allowed to tax the capital gain on the shares if the Cayman would sell the Indian subsidiary. But it's getting more difficult if the parent company of the intermediary sells the string of corporations. And the treaty, there is actually no treaty applicable because it's a third state dealing here with this. So it's domestic law, which is important to actually get this taxed if you want to tax this. And that was the main issue in India. Well, back to this, I leave the lines for later. The main issue was that this case was brought to the court. The Indian tax inspector said, I'm going to tax that indirect transfer because I believe that indirect transfer is taxable in India based on our tax laws. But the case was brought to the Indian court, and the Indian court said, no, that's not possible. We don't have a provision which allows India to tax this. So you're not allowed to tax this from this indirect transfer. And then because in Indian law there was a provision which describes a certain capital gain, and it was not mentioned there. And in that commentary with the domestic law, they changed that commentary retroactively in such a way that that specific situation could fall under that position. So actually, more or less, they just changed the law retroactively and said, okay, we lost that court case, but based on our new law, we can still tax you because it's applicable back to 2007. And then you get in a situation which is much more difficult to solve, because how can you act against the state which does something which is very specific? Normally, when you have a constitutional court, you could probably ask the constitutional court to deal with it. I'm not fully sure how the constitutional court works in India, but they did it in a different way. And Vodafone went in a bilateral investment treaty situation. And a bilateral investment treaty is something which looks a lot like a tax treaty. And it means that whenever a company from the Netherlands invests in India, that India should guarantee that there will not be any expropriation, for example, of the capital of the Indian company or the Dutch interest in the Indian company. And therefore, so they started based on the Indian-Dutch bilateral investment treaty, and in an unpublished decision of the arbitrary court, Vodafone won the case. So further, a few steps back, in 2014, India states disputes relating wholly or mainly to taxation are excluded from the scope. Well, you have to know that there are many different bilateral investment treaties, and some of them do exclude taxation from the scope. If there is no exclusion of taxation in the bid, then it means it's in principle applicable. There can always be some nuances and whatever more, but here India stated it's not covered. And yeah, still Vodafone didn't believe that based on the text of the bid, and therefore they issued a notice of arbitration, which is a basic step in order to apply the bilateral investment treaty. United Nations Conference of Trade and Development, investment policy hub, that's part of the United Nations, and therefore it's a very objective institution, has concluded that the bid did not exclude taxation, and therefore in 2016 India terminated all bilateral investment treaties. But still, this is an old case, and here Vodafone won the case before the arbitration court. So on September 25th, an international arbitral tribunal comprising of 3 people, from which one person, which name Orioma Blanco, is the arbiter assigned by the Indian government, even their own arbiter, they concluded that India wasn't right and that there was an infringement here on the bilateral investment treaty, and therefore, yeah, the tax assessment should be cancelled. Very importantly, it's a breach of the guarantee of fair and equitable treatment laid down in Article 4 of that agreement. Fair and equitable treatment sees amongst others also on the expropriation, because that's what you actually more or less create. So there are a few more provisions here which I will leave, but it's interesting to see that tax cases can also be brought to other arbitration courts, like for example, yeah, the Hague Court, but there are more courts. And you also see that there are also a few other cases. So we have in Peru the acquisition of Petrotech is currently pending under a bilateral investment treaty, and in Uganda the Zain case is also pending under an investment treaty. However, that's the bad thing. In the European Union, the member states have chosen to limit the possibilities of applying a bilateral investment treaty. In the Netherlands, for example, there is a decree that all bids should be renegotiated, and specifically for the financial industry, trust companies and so on, they always used or found the bids very interesting because they didn't require substance in order to apply the treaty. The new treaties all apply substance. There's still a lot of possibilities, but yeah, but as said, the Netherlands changed the treaties and India actually cancelled all the treaties. So India lost the case of indirect transfers, but actually you will see later here already won the case in a way, because they on the 4th of June, Platform of Collaboration on Tax, the joint initiative of IMF, OECD, UN and the World Bank, released a new toolkit concerning the taxation of offshore indirect transfers. And what does it mean? It's hardly possible. I will just do it in my words, also for timing reasons. It's hardly possible to direct an indirect transfer without specific provisions being included in the tax treaties. The MLI already created a solution for this, but it needed to be better, and it needed to be so that have been developed by this joint initiative 2 options for dealing with indirect transfers to be implemented by all the states, of which one of them makes it most easy for source states to tax an indirect transfer, and of course that's the one India chose. And therefore, actually, what we see is that although India lost the case in first instance, India is at the moment one of the most important states in the world with respect to taxation. Their approach on the United Nations Model Tax Convention is huge, which means that they are one of the initiators to change the convention again and again and again, because they want more and more and more and more. And they find a lot of the African states and all kinds of developing states behind them in order to change the system in a way which suits India. And here actually they were one of the initiators, and of course under the MLI there will already be some changes, but for the future keep in mind that an indirect transfer of a subsidiary could lead to taxation in a state where the subsidiary is registered. Keep that in mind if you're a tax a CFO or tax director. That's these developments will be affected soon, I assume. Now I don't see my slides. Here it is. This is the platform for corporation tax, the document. It's on the. You can Google it. If you cannot find it, let me know. I will send it to you. For timing reasons, I go to the last slide. The last part, chapter 10 of the transfer pricing guidelines. You have to know that we all know what transfer pricing is and how transfer pricing affects our business. There is never one specific price. There is never one specific tool to come close to a price. So whenever intragroup services were being provided, intragroup goods were transferred, it was always difficult. What is the system being applicable to that specific situation? And it actually took. Now let me go back. So we had 9 chapters in the transfer pricing guidelines, which is the OECD model more or less on how to look at transfer pricing. Keep in mind, by the way, OECD has the transfer pricing guidelines. The United Nations has the transfer pricing manual. UN transfer pricing manual, and the transfer pricing manual of OECD, United Nations, goes much more further in a direction of, again, the source state, yes, you can imagine, interest than OECD does. However, still, UN and OECD found each other here more or less, and they came to the conclusion that there was a lack in the transfer pricing guidelines because there was no chapter really dealing with financial situations, and they believed it was necessary to include that. So they came up with a proposal in 2018 to deal with this. Well, and actually it took them more than 2 years to come to a solution. And in the new chapter 10, you will find specific rules for delineation of loans, cash pools, hedging situations, all kinds of captive structures and so on, all kinds of structures. And what you see here is that the new rules are going to be quite difficult to follow for the Dutch and the Germans. In our both states, we have a lot of case law with specific loans, which are being determined to be no business loans. I'm not fully sure what the official English translation is because there is no translation. It's like non-business loans. These are loans which have so many characteristics of equity that we see them. Now, that's the wrong situation. They still perceive it as a loan actually. However, they don't allow a devaluation of the loan. But the criteria developed in Dutch case law, but also last year a German court decided that in a specific loan situation, the loan was provided under conditions which you wouldn't get whenever you would acquire a loan from the bank, and therefore the interest was not deductible. And you'll see a lot of these influences back in this new chapter 10. So the delineation of the loan is getting much important. So the few slides I'm going to use here, I'm going close to my final time, but I'm foolish. I hope that Robert and Joke still give me 5 more minutes. So I will focus now just on the loan. What you see here is the background of the change is actions 8 to 10, but also action 4. Yeah, which is specifically about intergroup loans and what kind of interest can be deducted, etc., etc. So it took OCD a very, very long time in order to come up with guidelines which work, which are not any longer a draft. So chapter 10 is now here as a basis for judges to use for interpretation. Keep in mind, by the way, not all states will accept the full of the transfer pricing guidelines as a source of law, for example, in a court case. In those situations, you could get a different approach of the situations. But more and more states are applying the transfer pricing guidelines and the model tax convention issues because it actually gives the possibilities, it actually expands their views, but then still, as said, the courts could have a different position. But here, from a dynamic treaty interpretation perspective, chapter 10, there was no chapter 10, but there was always a rule which has said that an intragroup loan should be based on arm's length principle. So by including a chapter which more or less describes on what arm's length is, it's probably for some courts not really a new thing, which means that there could be courts that use these criteria for situations in the past simply because they say it's not a new chapter 10. Chapter 10 is just an explanation of the existing rules. So let's go into a few of the issues here. So debt characterization remains a competence of the country, which means that if in the Netherlands, for example, a loan has so many criteria, so many aspects of capital that we see it as a capital contribution, that's up to the country. That's up to the Netherlands, that's up to Germany, that's up to all the countries which do so. The new guidance outlines a framework to assess whether a perpetual loan is accurately delineated as debt for corporate income tax purposes. That's the way they go forward. So they want to provide criteria which makes it more easy to precisely say this is a loan and those aspects of the loan are relevant. If tax authorities deem that an intercompany loan is not structured in an arm's length manner, it will be perceived an equity contribution or a different kind of intercompany loan. That's what we saw in Germany. So because the loan was not done and provided under the criteria a bank should apply, the tax inspector says, yeah, then the interest is not deductible, and the courts follow that. And that's a stupid thing in a way, because a bank does not know as much of a subsidiary than the parent company knows. And therefore, if you would really compare situations, a parent company can actually determine the policy of the subsidiary, and therefore is much more mighty, therefore much more in place to provide a loan with less independent criteria to still get the same security from the structure. So it's in a way a strange situation, but nevertheless, these are the new rules. So I already mentioned about the Dutch and the German court decisions. The intercompany transaction should be at arm's length from the perspective of the lender and the borrower. So that's not really a change. It's more a clarification of how you should look at it. A loan is a loan as long as there's a repayment clause. That's the Dutch perspective, that's the French perspective, that's the British perspective, that is the German perspective, it's the perspective of many, many, many countries. However, it shoots the facts. The repayment clause is easy. Paper, you put it to paper, you're ready. However, you now need to provide information which contributes reasons why that repayment is expected. So you should come up with some kind of a specific analysis which demonstrates that what the scheme is and how the and that in the future you have the money to pay back, etc., etc., etc. Accurate delineation also requires understanding of the functions performed and the risks assumed. So we will get, I see in practice often happening. Now, actually, I run a few transfer pricing cases. I'm involved in one cross-border loan situation. I see a lot of situations where there is a loan agreement. And in a way, I'm already happy that there is a loan agreement, since I've seen also a few situations where companies didn't even have that loan agreement in place. So make sure you have a loan agreement in place. Make sure that you put in that agreement more or less, or that you describe what kind of a function is performed and risks assumed have to be dealt with by the company providing the loan. So, because then you get a situation, for example, if you have an intermediary company in a very interesting location with a low tax rate, where all the finance people are, and they take all the risk, take all the decision, that is fine. But that's not always the case. Often, like the same situation with IP, you can see that there will be a finance department in a specific department in Zug, Switzerland, or wherever. And that's the situation here. So therefore, a much more descriptive way of analyzing the situation is necessary. If a lender in an intercompany loan situation has no capability or does not perform decision-making functions to control the risk, the lender will only be entitled to a risk-free return, which means that the residual will be allocated amongst all the parties using that loan. It's comparable to what I described about IP, and it all stems from actions 8 to 10 of the Bezos profit shifting OCT models, actions, I mean. How to benchmark intra-group loans? Well, preferred system is the comparative control price method, the CUP method. OECD says that they don't want to use the old practice anymore, where you just come up with a proposal from a bank, or an opinion from the bank, and so the bank says something like, we believe that that would be a reasonable percentage. That practice is not the preferred way by OECD. That doesn't mean it's per definition not acceptable, but that's not the preferred way. And therefore a CUP method seems to be an internal CUP, external CUP. OECD leaves it actually open. You have to choose the CUP which suits your situations as much as possible, actually. Finance documentation. We recommend to have detailed documentation available in order to avoid the characterization of the intercompany loans as equity. So work on documentation. Make sure that you have the documentation in place, and make sure you have the relevant documentation in place. I also see that there are some companies providing documentation which supports your loan structure, but it's not to the point, it's not business related, doesn't have all the specific analysis you need, specifically in the new rules you need. Therefore, make sure you do it well. There is not a limited list on what should actually be in a documentation, but the ability to pay, to repay, actually, as I mentioned previously, is an important one. A detailed overview of the terms of the loan is an important one. An overview of the way how the loan has been structured and which alternatives were available is also an important one. Why did you use it, one corporation over there? which KIP you used, and of course a functional analysis for the function performed, assets used, risk assumed, mainly with respect, but not totally, mainly with respect to the lender, but also to the borrower. The trend is, well, as said, chapter 10 is becoming extremely important. It's not just about loans, cash pools, captives, hedging, etc., etc. Many more issues to do. A lot of exciting developments in the international tax world. I will thank you all for your participation. You can always ask me questions. If you need the article or you need the toolkit, let me know. I'll send it to you. And I'll hand back the presenter's role to Robert to continue with this presentation.
Hans, many thanks.
Oh, sorry, Robert, you're next. You will start now.
Indeed.
Sorry for interruption.
So I will wait a little because there is a delay in getting the presentation on screen. So we've heard a really interesting story from Hans also that there is changing quite a lot in tax world. And that's also really the basis for, let's say, having tax tools in place. If we see what is changing in the tax world, and if we also see what we are living in the world right now with COVID, how we need to run a business, how we need to stay profitable. How do we also cope then to be tax compliant? How do we also cope then to really deliver data, what we can use for our tax returns? On the other hand, how can tax advisors trust that they will receive accurate and complete data? So that makes on that part really difficult to perform this job in a manual way. So we need to understand what is the risk that we are having. On the other hand, how do we remain in control and compliant? That is more the stage where I want to go to when we're going to talk about the tax tools. So there are many rules to go to automation in general, and also many rules to have tax compliance tools. On the other hand, also many ways not where you want to go to. But on the other hand, when we start about talking about facts and circumstances, what I've seen many times when I'm preparing transfer pricing documentation, I ask people in an interview, explain to me the process. Most of the times what I get is what they think the process should be, not a process that it actually is. So we can use, for example, process mining to see what the process actually is. It is in transfer pricing documentations highly important that we describe the facts and circumstances in a factual way. We are confronted right now, sorry, with increasing data volume. So we have a lot of data. We do not see all the value of it. So how are we going to manage that all the data that we have in different sources, in different countries, in different formatted ways, how we can make sure that we extract the information we need? The next step when we get is data quality. When I want to have, for example, my sales in the United States, and I make a pivot or I make a specification, most of the times I see 4 countries: USA, US, America, and the United States of America. We need to make sure that we cleanse all the data. Accuracy. How can we be sure that the information we receive is accurate? I've worked both in the US and now I work again in the Netherlands, and I still get confused. When do I use a comma? When do I use a dot? That can make a really big difference when I'm filing a CAT return. Timeliness. We all know that we have to file within time. If we do not file, we can get a penalty, we can have to pay interest. So there it is also really important that we get the data, that we get the information in time, also for the tax advisor to review, that we can send it in time. And in conjunction with that, we have the 80-20 rule. We want to be absolutely sure that what we send, that is first time right. But if we spend 80% of our time on retrieving the data, getting it into a nice spreadsheet, send it to the manager so he or she can review, then we just have 20% of the time left to be absolutely sure that we are accurate. The biggest reason for me to go to a tax compliance tool is Excel. Only thing what I want to tell about Excel, that it is flexible. Most companies, is what we see is they have this triangle. You're performing a business, you need to comply with rules and regulations. And if you didn't do a good job, then you will find yourself in defense or in litigation. In that part, it is always about how do I spend my time, how do I spend my cost? Do I accept the risk? Or do I want to be absolutely sure that I have a good reputation so that I will never get in the situation where there is litigation? Do I want to make sure that I comply on forehand, or do I think, hey, I can fix it afterwards? So when we look at the example, there we have the numbers again. So I have my business over here. Here's what I spent on compliance. Here is what I spent on litigation. In a desired situation, I would spend about half of my time both on the business, both on compliance. There's always a little chance that there will be litigation, so that's not something that I can exclude. But if I think, hey, I'm spending the time on my business and compliance, it's quite expensive and it doesn't add value to my business, then for sure the risk will increase that you will get into a situation. So that's where we look at. What is important? Important is that you have reliable information at the time that you need it. You don't want to have information 1 week late or 1 month late. You want to have it near real time. You need to be able to perform analysis on it. If you see something is wrong, you need to perform root cause analysis to get to the cause, enabling you also to take the action you need. So only with the accurate information presented in a way that fits your purpose, you can create value. You can take the steps you need. So there is where we specialize in getting from data to insight to value creation. And that is the basis working towards the tools we are offering, and that is more about making your life more easy in the compliance part. So also having tools in your internal control framework, in your tax control framework, where you have a clear view on the audit trail and where you know that you're in control, and also where the external auditors or the external tax advisors can work with. So the first tool is TrueUp. TrueUp is a tool where we really work on making sure that what we have defined as a profit in my transfer pricing documentation, that is also the actual profit, what I have in my general ledger. It will calculate any difference, so you know what you have to post as a year-end adjustment. Hans has explained quite a lot about loans and the difficulties to be compliant and also the risk that is there. That's why we have built a loan compliance tool, making it really more easy for you to stay compliant. CFC compliance. Other tools that we are using, unfortunately, we didn't develop it ourselves, is from Enterprising Solutions TP Genie. But most important, we want to make sure that we get the data in the tools. So on the next slides, I will tell you a little more about what the tools can be doing. And I hope that that really inspire you about the next steps to take. So the true up tool, what I just mentioned, it gives you insight in your period end, most of the times a year end adjustment you need to make to get your actual numbers in line with your transfer pricing documentation. But you don't want to do that really on year end, on the last day of the month, probably on the last day before you make your financial statement final. So that is why we want to make sure that it is on a near real-time base, that you can check it on a monthly base, on a quarterly base. So making it more easy for you to stay in control. Because we are human, we make errors. That's also why we're really trying to limit human interaction as much as possible, making sure that we directly connect to the source data, making all the calculations, and making sure that you get a document that is showing a transparent and verifiable audit trail. So that's also something where the auditor can support on, or the tax authorities. This tool is available both in the cloud and on-premise. And of course, when we look at, you are working with really confidential information, and that is why we have spent quite a lot of time making it a really secure environment. So we're working with secure data connections. Won't go into detail on that, but it's more about making sure that it is verifiable, secure. The loan and CFC compliance. It provides information about where you stand. So we were talking about a loan, and we need to have that arm's length. But getting back, it also needs to give a good view on the actual facts and circumstances. So I can draft a really good loan agreement, but if factual, if I don't act accordingly, I'm still at a big risk. But how are you going to check that? If you look at the first slide where you see the world, where you see a lot of countries, when you have about 50 subsidiaries, where you have in the company loans, you will always spend a lot of time making sure that you are compliant. So that is why we offer a tool where you can have those steps included, where you can see the steps you have taken, who has taken that step. So we have the RACI, but you also have a database where you have your benchmarking, if it is still accurate, where you have your loan agreements which are scanned. Talking about ex nihilo ETL. We have a tool, we have a source system, most of the times an ERP system. And we have data that we need to bring from the ERP system to the BI tool. We can work with USB sticks, but I think we've heard quite a lot of stories that didn't work well, but it takes a lot of time. So that's why we have developed an ETL tool, meaning extract from the source, transform into a specific format, and load it into the BI tool, which is flexible, which works with almost every ERP system, and which can transform it into any format. Making sure that you can transform it in an automated way, or you can transform it in a time or way you would like, get it into a BI tool, and you are absolutely sure that the data hasn't been manipulated. The next tool, TV Genie, is what we are working with. There are also other advisors working with. So what I really like from there is when we look at transfer pricing documentation, when we look at benchmarking, intercompany agreements, we try to automate as much as possible what we can only automate what is standardized. A big part of the master file, of the local file of agreements is standard. So why wouldn't we automate it? It reduces the risk of errors, and we can focus on what is really important, describing the functional analysis and all. So this is really, in a nutshell, what tax compliance tool can do for you. And it is really also a short story about, and there are many other tools. So as Hans also mentioned, I can talk hours about the tactical infrastructure. I can talk hours about what the tool can do. I can talk hours about how the tool can help you. But it's almost time. So as mentioned in the beginning, we will be hosting webinars every 6 to 8 weeks, where we have different topics, also topics that you can bring to the table yourself. And that will be more in the field of the specialism from or tax advisor or the C-suite, or maybe the IT department. So I really want to thank you for joining. I really appreciated telling you the story, and I hope that we have inspired you during these dark days. And I really would like to keep in contact. So I would say my big thanks.
So thank you, Hans and Robert, for these interesting insights. Next time we try to get Hans and Robert live on the screen. That's more nice for you to see, but at this time it was not possible. If there is a need for more information, like Hans just explained also, it is possible to receive the PowerPoint presentation of Hans. Just send me an email. You can find it on the LinkedIn page. Also, we will have a look into if the webinar can be broadcasted again on YouTube. And hopefully we will see you at one of our next webinars, and that will be in a more smaller setting, but also more suitable for the audience that we have. If you have any topics that you would like to address, just send us an email and we are looking if that is a possibility. Thank you and have a nice evening.